Fast money stocks snapping a 4-day win streak as investors digested the latest bond auction and some new inflation data. The Dow falling more than 170 points. S&P and Nasdaq both down 0.6% off the lows of the session. Shares of Birkenstock falling nearly 7% in the second day of trading, adding to its initial first-day drop. Stocks now trading around $37. That's down about 18% from its IPO price. And then shares of Dollar General jumping after hours. The company appointing former CEO Todd Vassos to step back into the role effective today. Dollar General also lowering its full-year earnings outlook. Well, speaking of earnings, third quarter bank earnings kicking off tomorrow. J.P. Morgan, Wells Fargo, and PNC reporting before the bell. Our next guest says reserve building is more important for the group than earnings beats for this quarter, with investors still worried about credit quality and how banks would fare in a potential recession. Christopher Marinac is the director of research and a bank sector analyst at Janney Montgomery Scott. So you expect banks to put aside more reserves for credit losses, Chris?
I do, Sarah. I think that's the right thing for them to do this quarter, and I think it's a better part of valor to miss earnings estimates and build reserves this period.
What is that good? Is that clarity for investors that want to own these stocks for them to do that or not?
Sure. Recognizing credit risk is exactly what banks have to do right now. I think the concern is that banks are not investable because of credit concerns and worse economic activity next year. So the solution and the vaccine, if you will, is building reserves, creating new confidence, and reminding investors that banks are going to continue to lend and continue to take deposits as they move through these next couple of quarters.
What about the banking business this quarter? We saw another quarter of higher interest rates, which should help on some profitability metrics, but there are clearly reasons to be cautious as well.
Well, the higher interest rates are a double-edged sword. On the one hand, deposit costs continue to reset higher, and that's squeezing margins. On the other, you have higher rates on loan yields, which will continue to remix and help margins stabilize probably in the first quarter of next year. Higher interest rates are actually very helpful for most banks. We think new loans are going on the books at 8 to 8.5%, still very materially better than the yields that were around 5 to 5.50 from last quarter. So that's going to help as we move forward. I think the challenge is that the Fed pause can't happen soon enough for deposit rates. So deposit costs will continue to go up again in the fourth, but we think it's going to stabilize sooner versus later as next year develops.
Chris, it's Tim. Thanks for joining us. So you've talked about pricing in and provisioning and the recession. And let's presume that the market has done a decent job of calling a mild recession into banks right here. But then how about banks, money center banks trading at 50% of a multiple of the S&P, which is extreme by any time, any measure, anywhere? Do you think that's warranted? And it's hard to go out and buy banks. I agree. But that seems to be getting pretty compelling.
I agree with you, and it's one of the reasons that I think the KRE and the other benchmarks can really rally this next 3 to 4 weeks. There's no reason you can't get a 10% move or higher in these stocks. For one thing, I think the market multiple may actually come down, and the banks relative can go up. I've lived my career where banks were hanging out at 75 to 85% relative multiples, to your point, Tim. Mm-hmm. So I think that's extremely possible. The question is timing. We still have to consider that credit gets worse as next year plays out. I just think the banks will reserve for it and that they have enough earnings and capital to get themselves through.
Chris, J.P. Morgan is going to come out with a book value of basically $100, trading at basically $150. I can do the math. So they traded a premium to a lot of the other banks. But at a certain point, when some of these banks are trading 65, 70% of book, how does that reconcile itself? I mean, I get they deserve a premium multiple, but does J.P. Morgan's come down or does Citi, Bank of America, Wells go up?
I think it's more the latter, that the pricing goes up for the others that are too inexpensive. JPM's a great franchise. They make a lot of money. They have a lot of confidence with investors that they'll be the leader throughout this cycle. The challenge is that the other stocks should not be ignored in favor of JPM. I think that you should do the opposite and actually bid them up. Book value may grow faster next year as the interest rate marks start to back away and actually come down. It'll be negative on the marks this quarter, but next year could be a whole different story. The Fed doesn't have to cut rates for the rate marks to actually start to help banks. We've got natural amortization, natural payoffs, and then any movement in yields downward and pricing getting stronger on the fixed income world, particularly in the residential mortgage-backed securities, could actually be a big lift for banks' book value.
Is that why you like some of the regionals best? I'm looking at your note. Looks like your best ideas: Fifth Third, First Citizens, New York Community, Synovus. These have been the most pressured from higher rates and potential pressure on reserves coming out into money market funds.
That's correct. And each of those companies have the ability and the leadership to actually work additional both reserves higher, but also keep lending money. We think there's a market share movement away from certain banks to these regionals. I think the regionals have been completely ignored, and they should not be. Many banks are going to pick up share from each other as you move forward. In fact, I actually think the too big to fail banks may see deposit share leave as the next year to two play out.
All right, Chris, thank you for joining us with some of your predictions ahead of bank earnings.